taxable brokerage account. This is probably the account that you think of when someone says investing. It's not for retirement, it's just for building wealth. But since it isn't for retirement, that means you can kiss your sweet tax breaks goodbye. You will have to file typically 1099 div forms every tax season for an account of this nature, and the IRS will tax the ordinary and qualified dividend gains annually, even if you are reinvesting them, as most of us are and should be. Same with 1099 INT forms if you have bond interest in this account. So it bears repeating at this point that I am not a tax expert. I am not an accountant. I am literally just a human being who has filed her taxes for her investments before. So if you want to know more about your investment taxes specifically, you could consider getting an accountant to help, or my personal favorite recourse, call your parents. But although it's not as tax friendly, the individual investing account is a wonderful place to put extra money. Much, much better than stowing it away in a savings account every month. Of course, technically, the most responsible thing to do would be to avoid an individual investing account until you've maxed out that 401k with the $20,500 per year. That's $1,708 per month. The Roth IRA at $6,000 per year. That's $500 a month. And the HSA, if you have one, at $3,650 per year. That's $304 per month. But I mean, look, my philosophy is this. While I will need money in retirement, no doubt, I will also probably need some wealth that I can access penalty-free in the next 10 years to buy a home or have a kid or to do literally any number of things that come before I leave work. I don't necessarily want all of my invested wealth to go toward retirement, because that means I'd have to wait to start taxable investing until I can afford to max out a 401k, a Roth IRA, and an HSA, and that might take a while if I'm not this super high earner. Even though we've just laid out the technically most tax efficient way to proceed in this episode, and you should undoubtedly take advantage of your accounts that offer the tax benefits, it is always worth weighing your other medium-term goals here and determining if you should be tossing a couple hundred a month into an account that's not a qualified retirement account. Sure, it's going to sacrifice some of the tax optimization, but flexibility is very valuable too. I used to contribute 15% to my 401k, $500 per month to my Roth IRA, and actually around $800 per month to my taxable account when I worked full-time making $60,000 per year and part-time as a fitness instructor for another $1,000 or so per month. I was not yet maxing out the 401k, but I wanted the flexibility of the funds in that taxable account, and I couldn't afford to do both, so I split my contributions between them. All that to say, it may not be perfect, but if you cannot afford to do all three or all four, it is okay, absolutely, to adapt to create some flexibility. You also probably remember, if you listen to the deep dive into paying no taxes in early retirement, that the taxable brokerage account is a vital part of the puzzle of early retirement. It is pretty much impossible to retire early without one, unless your spending is less than the standard deduction, which isn't unheard of, but is frankly pretty hard to do. If you're not going to retire until you're 60 or older, then it's not as important that you're contributing to one of these. But if you plan to tap dance out of the boardroom at age 40, well, you definitely need to be making that taxable account a priority too. All three buckets, and maybe four if you have and can afford to leverage that HSA, should be receiving contributions if that's the goal.